In this video, we will talk about some of the options available for saving taxes under Section 80C of income tax. Specifically, we'll talk about PPF, ELSS and NPS. If you're hearing these words for the first time, then don't worry, you're not alone. You will have a pretty good idea by the end of this video. So let's start. This video is brought to you by Dhanwise. Dhanwise helps you connect with an experienced and trusted financial advisor to manage your mutual fund investments. If you need help with your mutual fund investments, go to dhanwise.com. Alright, what is Section 80C of the income tax? Section 80C allows you to deduct up to 1.5 lakhs from your taxable income for some expenses or investments made by you. There are many ways you can claim this deduction and the list is very long. But by far, the three most popular investment options are PPF, ELSS and NPS. Let's talk about them now. PPF stands for Public Provident Fund. It is a government-backed savings scheme which works like a bank fixed deposit, but with some added advantages. Interest earned is completely tax-free, so it has double tax advantages. It allows you to get a 80C tax deduction and also earn a tax-free interest income on your investment. It is a government-backed savings scheme, so it's considered very safe. Interest rate is higher than most bank FD rates. The interest rate is fixed by the government every quarter. As of Jan 2020, the interest rate is 7.9%. One big disadvantage of this option is that it has a lock-in period of 15 years, which means that you won't be able to withdraw money before 15 years. If you are investing in PPF for a long-term goal like retirement, then this lock-in period of 15 years should not be of concern to you. So if you are looking for a long-term, stable and safe investment option, then it can't get any better than PPF. ELSS stands for Equity Linked Savings Scheme. It is just a fancy name for equity mutual funds. Every mutual fund house will have one fund under the ELSS category. For example, Axis Mutual Fund is a mutual fund company and it has one ELSS fund named Axis Long Term Equity Fund. Equity mutual funds have the potential to generate higher returns if the stock market performs well. So if you wish to save taxes while also participate in the stock market, then you should opt for ELSS. However, since the returns are linked to the stock market, these investments can be volatile in the short term, which means your investments could lose value if the stock market goes down. Also, there is a lock-in period of 3 years, which means you won't be able to sell these mutual funds for 3 years from the date of purchase. However, equity investments typically work well in the long term, like 7 years, 10 years or above. So this lock-in period of 3 years should not be a concern. So if you are willing to take some risks and invest for the long term to get higher returns, then you should opt for ELSS. The last one, NPS. NPS stands for National Pension Scheme. As the name suggests, this scheme is designed to give you a pension after retirement. In this scheme, you open a pension account with an NPS fund manager like HDFC or SBI and invest in this account at regular intervals during the course of your employment. The pension fund manager will deploy some of your investments in equities, which are nothing but stocks of companies, and some in corporate and government bonds. If you are a private sector employee, you can choose what proportion you'd like to be invested in the stock market and what proportion in bonds. We won't go into the details here because things will get too complicated. As you can imagine, NPS combines investments in the stock market, which can potentially earn you a high return, with investments in bonds, which can earn a stable return. The biggest advantage of NPS is that you can get an additional 80C deduction of 50,000 over and above the 1.5 lakh limit, which means your deduction limit becomes 2 lakhs instead of 1.5. The biggest disadvantage of this scheme is that your money is locked in until the age of 60. Yes, you heard that right. Your money is locked in until the age of 60. Well, you are allowed to partially withdraw some amount after some time, but for all practical purposes, most of your investment will be locked in until the age of 60. Not just that, even at the age of 60, you cannot withdraw the full amount. You're only allowed to withdraw 60% of your portfolio, and for the balance 40%, you have to use it to compulsorily purchase an annuity. What's an annuity? An annuity is like keeping a fixed deposit with an insurance company. The insurance company will pay you a fixed interest rate for the rest of your life. However, you can never fully close this deposit, which means you never get back 40% of your NPS portfolio. You can only earn an interest on it after your retirement. So if your risk appetite is very low and if you're okay with keeping most of your money locked in until the age of 60, then you can opt for NPS. If you opt for ELSS and need help with choosing ELSS mutual funds, then head to dhanwise.com. We will connect you with an experienced and trusted advisor who will take care of your mutual fund portfolio.